Welcome to TalkTickers. We're diving deep today, acting as your guides through the latest Buckle first quarter earnings call for fiscal 2025.
That's right. We've gone through the transcript, the numbers, the Q&A. Our mission is basically to pull out the key stuff for you so you get the picture quickly without needing to wade through it all yourself.
Exactly. So let's get straight to it. The headlines for this 13-week quarter, it ended May 3rd, 2025. What were the big numbers?
Okay, top line. Net sales hit $272.1 million.
Okay.
That's up 3.7% from the $262.5 million they did in Q1 last year.
So solid growth there. How about comps and online?
Yeah, comparable store sales, they were up 3% year over year, and online sales also had a nice bump, up 4.5% to $46.4 million.
Good to see both stores and online pushing forward. How did that filter down to profit, net income?
Net income was pretty flat, honestly. $35.2 million, just slightly up from $34.8 million.
Okay.
And that meant diluted earnings per share, or EPS, was 70 cents. Again, just a penny better than the $1.69 last year.
70 cents.
Yeah.
Got it. Any mention of like basket size or price points?
Well, yeah, they mentioned slight increases there too. Average unit retail AUR was up about 1%, and the average transaction value was up around 1.5%.
Okay, so maybe slightly higher prices or, one extra small item per bag, something like that. Now, let's get into the mechanics. Gross margin. What happened there?
Gross margin improved, actually. Came in at 46.7%.
Right.
Which is a 70 basis point increase from 46% last year. And remember, a basis point is tiny, 1/100%, so 70 is a noticeable improvement.
That is a good move. What drove that? Better buying, less discounting?
Mostly better merchandise margins. That accounted for 60 of those 70 basis points. So yes, likely selling things more profitably.
Okay.
And the other 10 basis points came from leverage on the buying, distribution, and occupancy costs. Basically, a bit more efficiency in operations relative to the sales level.
So product profitability was really the star for gross margin. But then you've got the operating costs. SG&A, selling, general, and administrative. How did that look?
That's where things went the other way. SG&A actually increased as a percentage of sales. It was 30.7% this quarter compared to 29.8% a year ago.
Ooh, okay. So costs grew faster than sales there.
Yeah.
Why? Did they break it down?
They did. Several things hit them. A 45 basis point increase from incentive compensation accruals, probably tied to hitting those sales and maybe margin targets.
Right. Paying for performance. Makes sense.
Then 25 basis points from higher health insurance costs. They mentioned they're self-funded, so that just reflects claims activity.
Okay, they could be lumpy.
Yeah. Plus 20 basis points from equity compensation expense, often linked to stock price when grants happen. And then another 40 basis points across sort of other SG&A buckets.
Wow, that adds up. Any offsets? Did anything get cheaper?
A couple of things. E-commerce shipping costs were down 25 basis points as a percentage of sales.
Okay.
And certain marketing expenses were down 15 basis points, but, not enough to counter the increases elsewhere.
So netting it all out, better gross margin, but higher SG&A. What did that do to the operating margin overall?
It squeezed it slightly. Operating margin landed at 16% for the quarter,
okay,
which was just a tick down from 16.2% last year. So that SG&A pressure basically ate up the gross margin gain and a little more percentage-wise.
And taxes?
Taxes stayed consistent, 24.5% of pre-tax income, same as last year.
Okay, so big picture, sales up, gross margin up, but operating costs up more, leading to a slightly lower operating margin percentage. Let's switch to what they're actually selling. There was a shift in the mix, wasn't there, between men's and women's?
Yeah, quite a notable one. The women's business kept up its momentum really strong. It grew to about 50% of total sales.
50%? Wow, it was lower before, right?
Yeah, it was around 47% last year. So consequently, the men's side decreased a bit from about 53% down to roughly 50% now. So it's pretty much a 50-50 split.
Okay, so women's is really carrying the growth torch right now.
Yeah.
What were the specifics on the women's side?
Overall, women's merchandise sales jumped about 10.5% year over year. Denim, which is huge for them, was up around 11% in women's. And importantly, the average price, the AUR for women's denim, went from about $80.85 up to $84.85.
$85 for a pair of jeans average. What's pushing that up?
Management pointed to growth in their own higher-end Buckle Black label.
Yeah.
And also strong performance from, the national brands they carry. Seems like customers are opting for the premium stuff there.
Makes sense. Was it just denim or other women's categories too?
No, it was broad-based growth. They mentioned tops, shorts, dresses, outerwear, footwear, accessories, pretty much everything clicking on the women's side.
Okay.
And the overall average price point for all women's items went up about 2% from $48 to $49.50.
So a bit of inflation or mix shift there too.
Yeah.
Now the men's side, sales share dipped slightly, but how did the actual sales perform?
Well, it got better as the quarter went on. They said they actually saw positive year-over-year sales in April, which is encouraging.
Okay.
But for the full quarter, men's merchandise sales were still down about 2.5%.
Right. And men's denim.
Men's denim overall was down about 0.5%. Interestingly, though, their private brand men's denim was actually up about 1%.
So their own brand's doing better there. What about price points in men's denim?
Also up slightly, men's denim AUR went from $88.65 to $89.70.
So almost $90 average for men's jeans.
Yep. And outside of denim, they called out stronger performance in things like tees, polos, denim shorts, and even fragrance helped the men's category.
Oh.
And the overall average price for men's stuff was up about 1.5%, from $53.60 to $54.40.
Got it. How about accessories and shoes?
Accessory sales grew about 3.5%. They held steady at around 11% of total sales, and the average price there was up about 1%.
Okay.
Footwear, though, was a bit weaker. Sales down about 7%, so footwear is now about 5.5% of the business, down from 6% last year.
But prices up.
Prices were up, yeah. Footwear AUR increased about 2.5% despite the lower unit sales.
Interesting dynamic. And the youth business, they have that too.
Still growing strongly, up about 11 to 12% year over year. Seems like a consistent bright spot.
And one thing you mentioned with men's denim and also driving gross margin, private label. How significant is that becoming?
Very. Management really emphasized it. Private label now makes up 47.5% of their total sales.
Wow. Almost half.
Yeah, up from 46% last year. And they said that growth was seen across almost every category. It's clearly a huge part of their strategy. And as we noted, a key reason their merchandise margins improved.
Definitely something to watch. Okay, let's shift to the balance sheet. How's their inventory looking? Sometimes sales growth comes with bloated inventory.
Inventory was $132.4 million at quarter end. That's up only 1.3% from last year.
Okay, that seems pretty controlled given the sales increase.
Yeah, seems reasonable. And they're sitting on a good amount of cash, about $320 million in cash and investments.
Solid. And they're putting money to work, right? Capital expenditures?
They are. CapEx was $11.4 million for the quarter.
Where's that going?
Mostly into the stores and tech. $10 million was for new store construction, remodels, and technology upgrades.
Okay.
The other $1.4 million went into their corporate headquarters and distribution center. And depreciation expense was $5.9 million.
So $10 million just on the retail footprint and tech. What did that mean for the actual store count?
They ended the quarter with 439 stores in 42 states. That's actually one store fewer than last year's 440.
Oh, okay. So net closure.
Well, during the quarter, they did close 2 stores, but they also completed 5 full remodels. And importantly, 3 of those were actually relocations, moving stores, likely to better spots.
Ah, okay. Optimizing. What's the plan for the rest of the year?
They expect to open 7 brand new stores,
Okay.
complete another 16 full remodels, and they plan to close 1 youth store, but that's because they're combining it with a nearby full-line store as part of a remodel. So still investing heavily in upgrading and positioning the store base.
Got it. Let's move to the Q&A. Always interesting to hear what analysts are pressing them on. What came up?
Tariffs were definitely a topic. An analyst asked about the potential impact, especially from China, on gross margins going forward.
Yeah, that's always a concern. What did management say?
They said it's mixed. Some vendors, no cost increases. Others are seeing low to mid single-digit bumps. But they stress they're working with vendors on it, and vendors are also, moving sourcing out of China to other places. Management sounded pretty confident in their ability to manage it based on past experience.
Okay, so acknowledging it, but feel they have levers to pull. What else?
There was a question about the balance sheet, specifically operating lease assets or right-of-use assets. An analyst noted they were up about 10%.
Right, that sounds like a big jump. Why?
Management's explanation was pretty straightforward. It's just a direct result of all the new store openings and remodels over the past year.
Ah, the CapEx we just talked about.
Exactly. Accounting rules mean when you sign a new lease or significantly modify one for a remodel, you have to put an asset and a corresponding liability on the books. So that increase just reflects their investment in the store footprint.
Makes sense. Tied directly to the strategy, did analysts circle back on margins?
Yes. Someone asked for a bit more color on what really drove that nice merchandise margin improvement, the 60 basis points.
And the answer was?
Management basically reiterated the two key things: the continued growth of private label as a share of sales,
Right.
and strong regular price selling during the quarter. Fewer markdowns, basically. People were buying stuff at full price.
That's definitely a positive signal about demand or brand strength.
Okay.
One more.
Yeah, the flip side, SG&A. An analyst asked about those higher costs and whether they see potential to get leverage there, meaning could SG&A grow slower than sales if comps stay positive?
Good question. Can they become more efficient on the operating cost side?
Management kind of walked through the drivers again: payroll, incentive comp, health insurance, equity comp. They did note store payroll percentage was flat for the first time in a while, which is good.
Right.
But total payroll dollars were up because, variable sales commissions rise with higher sales. Incentive comp up due to good results. Health insurance depends on claims. Equity comp depends on stock price at grant time.
So it sounds like some parts are variable with sales, but other big chunks depend on other factors entirely, not straightforward leverage.
Exactly. It's not just a simple sales up, costs down as a percent situation. It's more complex than that, based on their explanation.
Okay, so pulling it all together for you, the listener, this deep dive really paints a picture, doesn't it? You see the top line growth, but then you understand what's driving it, specifically women's, youth, and private label.
Right. And you see where the profitability improvements are coming from that merchandise margin boost, thanks to private label and full price selling. But you also see the counter pressure from rising operating costs like incentive pay and health insurance.
And you get a sense of their priorities through their spending lots of investment, going back into remodeling stores, relocating them, and opening new ones, plus technology. And finally, you hear how they're thinking about external things like tariffs.
It gives you that much richer context beyond just the headline EPS number.
Which leads us perfectly into our favorite segment. This is not financial advice.
Emphatically not financial advice. We're just talking here. Consult a professional, please.
Absolutely. But if you were looking for an outrageous, maybe plausible if you squint, takeaway from this call, that private label growth is pretty striking, isn't it? 47.5% of sales and driving margin. It is. So hypothetically, purely for entertainment, you could decide that private label is the only thing that matters. You could maybe extrapolate that growth trend way out, assume it keeps accelerating, assume it translates directly into huge margin expansion, ignore all those pesky SG&A realities we just discussed.
Right. Ignore the rising costs. Ignore inventory, ignore tariffs, and maybe, just maybe, construct a super bullish short-term narrative, perhaps thinking about some, very speculative call options based solely on the idea that private label momentum surprises everyone next quarter.
A trade built entirely on one data point, ignoring all contradictory evidence and risk. Sounds about right for this segment.
Precisely. Remember, not financial advice, just connecting some dots in a potentially irresponsible way for fun.
Couldn't have said it better myself.
Yeah.
Okay, that wraps our TalkTickers deep dive into the Buckle Q1 Fiscal 2025 earnings call. Hopefully this gave you the key insights without the hours of reading. Until next time.